My name's Simon Lindley. I'm the Director of Business Development for the East Midlands for Cambridge and Counties Bank. I think the main advantage is that residential investment portfolios allow you a broad range of investment criteria. And so if you've got a low level of risk that you want to take, great, you can go and buy a 3 or 4 bedroom detached house in a nice suburban area. It will give you good capital growth over several years, but it will give you a low level of rental return, so you won't be able to borrow as much on the property. At the other end of the scale, you can go and buy a multi-occupied property, which will be in a less desirable location. The capital growth won't be as great, but the level of rental return year on year will be a lot higher, but it will require more maintenance from yourself. So there's something to fit everybody there, but you have to be conscious of your level of risk appetite. On the disadvantage side, you must remember that your capital is tied up and it could take several months to liquidate your cash. Therefore, you've got to keep behind a degree of cash to cover personal emergencies in case of need. I think the first step is to identify the actual property you want to purchase and its true value compared to what the market agent value would be. And then importantly is to find out the level of market rent that will go with that property. The market rent is the key figure because that will allow the bank to work out how much it'll be able to lend you against that property. After that, it's providing the bank with a background picture through an asset and liability statement and an income and expenditure statement. Essentially, an asset and liability statement is where you list your personal assets like house, cars, investments and cash against any liabilities you may have like your personal mortgage or any other buy-to-let mortgages, credit card debts, car loans, etc. And then the income expenditure side just covers your personal income, monthly income, whether it's paid employment or surplus rental income, against any personal expenditure you may have for your personal mortgage, car loans, etc. The main reason for this is so that the bank can establish how much you've got as a personal net worth in case you need to put some more cash into the deal, and secondly, to establish that you don't require the rent to live off, so that the rent can be used to meet the loan repayment. Most funders will allow you to borrow in your personal name or joint names with business partners or your life partner. The more specialist funders like Cambridge and Counties Bank will allow you to borrow in a limited company name or a limited liability partnership name, or sometimes even in a trust name. The one thing you will not be able to borrow in is a pension fund name, as the present regulations do not allow residential property to be purchased in pension schemes. The value of the property shouldn't really be affected, provided you take legal advice and you let the property on an assured short hold tenancy, most commonly known as an AST. By that I mean your property will be let for a maximum of 12 months, and therefore you have the right to sell the property after that period when it's vacant. Therefore it won't affect the property value. In the case of the higher risk properties, the multi-let occupancy properties, you will find that actually having it let will actually increase the value of the property, because most of the buyers of that property will be investors and they will much prefer to have tenants in on day one. In any area of tax, I think you must start off by saying go and speak to an accountant, because they will be able to give you the best advice and the most up-to-date advice. But with residential buy-to-let property, you must remember this is not a personal property, so therefore it is a business transaction. So therefore you will be liable to pay tax in a business manner. So on that, the two levels are on the value side. As the value goes up, you will have to pay capital gains tax, and on the income side, the rent you receive will be treated as personal income, and again you'll have to pay personal income tax on that. There are costs that can be offset against both of those taxes, but again I'd point you back to going to see an accountant as the best source of advice. The main transaction fees that will go with a mortgage will be the arrangement fee to the lender. There will be a valuation fee, and there will also be a legal fee to pay for both your solicitors and, in most cases, also the bank solicitors. I think the other fee that you must be conscious of is that most mortgages, buy-to-let mortgages, will have with them a early repayment charge if you come out of the loan early, and I think you need to make sure you're fully aware of what those charges are before you enter into the loan. I think the size of the team you need around you is dependent on how large your portfolio is and how large you want it to grow. This is a business or an investment portfolio. So you would start with your accountant. I think an accountant will advise you on how to structure the portfolio to start with, whether you have limited company or whether you do it in personal names. You then move on to a solicitor, and whilst some funders will allow you to use their in-house lawyers as part of their fee package, you may want the protection of using your own solicitor at all times. Also, whilst the bank will have a valuation done, you may want to have your own structural engineer on board who will do a survey of the property. Again, this is dependent on how old and the condition of the property that you're buying. You want to make sure this is a big purchase, that there are no hidden costs involved. Also, I think it's important, if you're going to look to grow your portfolio, that you get a funder on board that will share your vision as to how that portfolio will grow and how it will look going forward. At Cambridge and Counties Bank, we pride ourselves on being a specialist property lender, and we appreciate that not every single transaction is straightforward. Therefore, we do not adopt a tick box computer approach to how we assess our loans. Everything is done manually by experienced business development managers who are very approachable. You can contact them directly. We appreciate that the borrower wants a quick, efficient service. They want a fast response time so that they can secure the property that they're trying to buy. And we understand the importance of working together with our clients to help build an overall vision as to what they want to do with their property portfolio and how we can help each other work forwards.